Welcome to the BF Anderson Technical Report for October 31st. Let's get right into the charts here. As we can see, the NASDAQ is starting to firm up here. We pulled back, correction, started to rally, very close to making a new high. Moving averages are turning up, very positive. However, there is some divergences going on, which we will discuss. This is the weekly graph. Again, we held the 35-week moving average. Moving average is moving up. Looks very positive. Now, the divergence we're seeing here is that the NASDAQ is underperforming the consumer staples stocks. Now, I call this indicator the leaking boat indicator, meaning that, yes, the indexes look good. They're making new highs, but the boat's leaking. Now, this is a warning. It's not a red flag. It's more of a yellow flag. But I went back and I really evaluated and back tested this ratio. Now remember, the ratio is comparing the NASDAQ to the consumer staple stocks. So we're basically comparing technology stocks to toothpaste stocks. Go back in time with me here for a minute and look at the year 2000. A big rally in the technology stocks, the dot-coms, started to break down, gave you a death cross right here in around June of 2000, and really bad things happened. We went into a real difficult recession, bear market. Then the indicator called the bottom, and it turned up. Now, the thing that's interesting about this indicator is that it has effectively called every market top and every market bottom for the last 20 years. Now, we came off that 03 low, stabilized, then starting in around June of 07, we started to break down again, and this was the financial crisis, so bad things happen. So you can, down here at the bottom, I've got the S&P 500. You can see that this was a market top. It called the top. This was the bottom. It called the bottom. Then around 09, right, in the first quarter of 09, we started to see the market bottoming, and the indicator gave a golden cross, which was very positive, and called the bottom of the bear market. Now, growth stocks really didn't outperform in any big way all during this period until around 2013, around June of 13. You can see here we got that golden cross. 13 was a really good year for growth stocks. We had a good year that year. But then starting in 14 and 15, things really got soft. We then broke down and gave a death cross and then rallied. So currently, we are on a death cross. We are on a sell signal. So this is a warning. The market's hitting new highs, but at the same time, a certain category of stock is driving the market to new highs. Things like Campbell's Soup, Procter & Gamble, those types of stocks. These are stocks that are defensive. Now, I'm going to look at the graph, this ratio, one other way. In the prior graph, we eliminated the ratio just to show the moving averages. Here we have the ratio. Now, I do think this 14, 15, 16 period is interesting because the growth stocks went into an underperformance cycle after having a real good 13, consolidated the growth stocks underperformed as they consolidated their gains. However, it was a very difficult period. It lasted 2 years, and then finally just a major drop-off in growth stocks, bottomed, and then we turned up. So it really is important to understand this because this was a 2-year period as a growth investor that you had to just bite your lip and be patient. Then we got the bottom, and then in 16 we actually got the golden cross here. Good things started to happen. Then we peaked in June of 18. So this particular cycle that we experienced between 16 and 17 peaked in June of 18, dropped, and is now moving sideways. Now the index is actually back above the lower moving average, and the lower moving average has turned up. So we're seeing some improvement. And this is a double bottom. So like back here, we had a double bottom, and then we rallied. So hopefully we're at the tail end of this underperformance cycle in growth stocks. Usually these cycles tend to last between 18 and 24 months. Let's just see what happens. But also, just to kind of make the point, I have a ratio down here where I'm comparing Facebook, which is a growth stock, to Procter & Gamble, which is a consumer staple. You can see right here in June of 18, that ratio peaked, and the growth stocks, meaning things like Facebook, Amazon, so forth, have been really underperforming, ever since. Now, on just other indicators, the advanced decline line continues to look good. We're at a good positive uptrend. So like I say, the indexes are fine. It's just the growth stocks that are having trouble here. New lows on the New York Stock Exchange. Again, this is another leaking boat indicator. In other words, if the market starts making new highs and at the same time the number of new lows gets over 40, and we had 42 yesterday, that is somewhat of a warning. The long-term indicator, the 1020, continues to look very positive, in fact, improving. Like I say, these indexes look fine. We're still in a bull market. We're just in a rotation out of certain areas that were good in 17, consolidated the gains, and now we're trying to rebuild. Now, on the global Dow, we continue to move sideways. Really nothing to report there. However, a breakout above this area here would be very positive. Value line geometric, same situation. This is the average stock. This is probably one of the best indexes that you can look at. This is what you're looking for. You want that kind of uptrend, the uptrend that got started in 1991, 1995. You can see how powerful that was, and that was where the average stock was doing incredibly well. Well, we've come up to these highs 3 times, broke out in 16, 17, pulled back, made a higher low. Now we're just moving sideways. So this index is really kind of giving a truer picture. Now on sentiment, we're seeing, somewhat a little bit of optimism coming in, a little bit of greed coming in, somewhat neutral. Now, what I wanted to do here was to go back to 1974. Now you have to use your imagination because the graph stops at 1980. But if you go back to actually 1966, the Dow Jones Industrial Average hit 1,000 for the first time in 1966. Then we went into a deep recession, kind of similar to the 09 situation, where the market bottomed in 74, just like it did in 09, and then rallied up until 1984. So it rallied for 10 years. And then from 1984 to 2000, which would be from here to here, it rallied for another 16 years. So the market basically had a 26-year bull market. Now also notice here that you've got this 200-week moving average, which has really been a very good way to keep a tab on trend. The only time that the 200-week moving average was violated was during bear markets. You can see here, bear market, really never gotten to an uptrend, really barely gotten up to an uptrend, then broke it again. However, if you look at where we are today, we're in a very good place. This is very solid uptrend, and this, going back here, this was the period last year where we pulled back. However, all I can say is that from 1984 to 2000, the S&P went up 814%. So this was really a good bull market, consolidation, breakout. Let's just hope that we're getting ready to see the same thing. Now, this is an index that, not an index, this is an exchange-traded fund called the IBD 50. These are the top 50 growth stocks that are in the database for Investors Business Daily, which is a publication that is similar to the Wall Street Journal. But this really shows a picture, a typical picture of what's going on with the growth stocks, because this is 50 growth stocks, and they're the top 50 growth stocks in the IBD index. Well, you can see here, this is last year where we got the big drop going into December, quickly bottomed, turned back up again, and we've been pretty much moving sideways ever since. and the index or the ETF is actually in a downtrend. Now this is called a triangle formation. It's kind of obvious. Now you can also see here that I've got support and resistance. We've been stuck in this range here really going on about 16 months. Now, if we can break out above 34, 35 on this particular ETF, I think that's going to be something important. However, if we break down, below 31, 30-ish, that would not be good. That would be kind of an indication of a bear market. Now, here's the yield curve. Now, the reason I'm showing this is, back here when we went into inversion of the yield curve, this was the main thing the media was talking about. Now interest rates are starting to climb again, and we're starting to see where the yield curve is no longer inverted. Just an update. Now the top 5. Again, this is a watch list. We're in earnings season. You're going to see a lot of gap ups or gap downs. This is Crocs, which is footwear, rubber shoes. You got a major up move here yesterday. Breakout on earnings. This is KLA Tencor or KLA Corp now. Semiconductor manufacturing looks very positive. Lam Research, semiconductor manufacturing. I think what the market's telling us here is that we're getting ready to see a whole new wave of semiconductor chips that are being designed and developed as we speak, and that these companies that make the equipment to manufacture these new semiconductors are benefiting. Again, this just shows you how the list is changing. This is Reliance Steel. So we've actually got a steel stock breaking out to the upside on very good earnings report. This is Seattle Genetics, which is a biotech stock. Again, it broke out on heavy volume on some test results that they came out with. So all in all, what I'm saying is we've been here before. Growth stocks start underperforming. Staple stocks start outperforming. It's a warning. It really is a warning, and we would say, as a growth investor, we would be very careful in this environment. We just need to be patient right now and wait for some type of guidance on things like the IBD 50 if it were to break out, or if we see a reversal of the trend of these NASDAQ versus the staples. Call me if you have any questions. Thank you.